There's not a single thing that
Right.
any one of us can do to stop a recession or stop a market downturn. We can, however, control our own personal finances. And that's what we have to do. So the three major things we all have to consider. Number one, if we're already retired or if we're about to retire. Number one, and first and foremost, you have to understand where your income's going to come from. So, do you have enough emergency reserves? I typically want my clients, the first 2 years of their original retirement, I want them to have about 2 years worth of income stacked up so they don't have to pull from potentially assets that have been hurt a little bit, right? So you have to make sure you have a good cushion. Now, I typically want emergency funds to be around 6 months, and that's not just me. I mean, you can go to Bankrate.com, you can go to Fidelity, you can go to Schwab, Vanguard. They all say a similar thing, about 6 months worth of just straight up cash reserves for your emergency fund. But you want short-term instruments that are still earning something, right? Luckily, interest rates are still high. So we can still get 4 to 4.5, maybe even 5-ish% on safe liquid assets that we can keep that 1 to 2 years worth of income in, right? Because if you have that, you're not going to hopefully be forced to pull from those assets to create and provide you that income that you're going to need in retirement.